Good afternoon from Los Angeles. I'm here with Jeffrey Gundlach, CEO of DoubleLine Capital, and also widely referred as the Bond King. And we are indeed here at DoubleLine Capital headquarters in LA. We're switching things up a bit. I'd like to note that the S&P 500 officially hit 4,900. The labor market ended 2023, adding 216,000 jobs in December, and we haven't seen huge cracks in the credit markets. Let's start there. Are markets and investors correct to be pricing in a soft landing?
I don't think they are pricing a soft landing, but if you want to ask the question, is a soft landing happening? I think that's just a euphemism. The economy is cyclical, and the business cycle has not been repealed, and the Fed's been tightening a lot. But I think what the markets are doing is trading on momentum. And we had our macro meeting that we have every Wednesday. It goes on for a couple hours. We had it today, and we survey all of the various sectors of the financial markets with an emphasis on the U.S., although we talk about global, and with a particular focus on bonds, because that's the bulk of our assets. And something has happened that's really interesting, and that is that when the Fed got dovish November 1st, suddenly real yields stopped going up, and we had rallies in everything. And it started out that it was the blue chip categories that did well, and this is a pattern that I've observed many times in my career. So what happens is people feel good about blue chip things, so they start buying some S&P 500, and they buy some corporate bonds, and they buy some treasuries, and then something weird happens, and that is that the blue chips become overvalued. And so I think it's quite clear on a valuation basis that the S&P 500 is overvalued. That doesn't mean it's going to go down tomorrow, but it's overvalued versus its own internal history going back decades. The Magnificent Seven have stopped performing for 7 months. They're not outperforming the S&P. The S&P 493 since basically the middle of last year. They're doing fine. They're keeping up, but they're not leading. And so that seems to be a place where investors are finding a fully valued situation. Then suddenly we saw the things that had really lagged. So middle part of the capital structure in fixed income, commercial real estate in particular, where everybody's scared to death of the vacancy rates in office. I mean, we've seen significant properties, big office towers and stuff, go from offers of $330 million to bids of $130 million to transactions of $130 million.
Right. So
CMBS was really languishing. So were parts of the asset-backed securities market. I'm really talking about not AAA. I'm not talking about the junkiest stuff where you really should be worried. I'm talking about stuff in the middle that has some protection. But it was lagging badly. And we saw significant outperformance of corporate bonds, while a lot of these other sectors in the middle of the capital structure were languishing. Well, my commercial real estate team said something very interesting today, which I think is a good descriptor, shorthand for the situation. They said that 2-3 months ago, the market was priced like the world was coming to an end. And there was good reason for it to be priced that way, and particularly if you get into the office category. And then everything started rallying with the Fed pivot. Treasury yields fell over 100 basis points. Stocks went to, you mentioned 4,900 now today on the S&P. We saw these blue chip things rallying. But we didn't see this middle part. But now, all of a sudden, and this is classic, this happened in 2008, 2009 as well, the blue chip stuff gets very overvalued versus its internal or its history. And so people start to relax their value standards, if you will, and they start moving down into junkier things. So the commercial real estate team said the fundamentals since 2-3 months ago, when the market was priced for the world coming to an end, have gotten worse over the past 2 or 3 months. Not, majorly worse, but slightly worse. And consumer delinquencies are getting worse in parts of the consumer market. Yet the middle part of the capital structure securities are on fire. They're rallying like crazy. We bought a single A rated commercial real estate. It wasn't office exactly, but the spread has come in 175 basis points in 3 weeks. it's not fundamental. It's just momentum. And we call this a Grabby market.
A Grabby market.
Grabby, that's a phrase. That's actually an industry phrase. It means that people suddenly are lifting every offer. So there's new issues that are coming out, which haven't happened in a while. And they're coming out in the residential mortgage market, non-guaranteed, the CMBS market, non-guaranteed, the CLO market is back to par. And they're coming out and they're oversubscribed, not one time, 20 times, 25 times. There's 25 times more demand than there is supply of these new issues. So this is the type of thing where I call it a lazy or a complacent type of market, because people start to do things that they wouldn't have contemplated 2 or 3 months ago when the prices were much lower, the yields were much higher, and the fundamentals were slightly better. And yet they can't get enough of this stuff. This feels like the type of environment that we experienced entering the year 2000, where you have tremendous narrow market that's broadened out because of grabbiness, because of momentum. And I think that the data that people are looking at is not really all of that informative.
What do you mean by that?
Well, I noticed that one of the things that was all the rage for being optimistic on the economy was the JOLTS numbers. Remember that? There was this huge excess of job openings versus people looking for jobs. But what people don't really do, they don't really look underneath the hood. They don't really go down into the weeds, and they don't realize that they're not comparing. The data they're seeing isn't what it used to be. So I'll give you an example on the JOLTS. About 5 years ago, they put out this survey, and I'm always very suspicious of surveys because they can be manipulated pretty easily, like polling can be manipulated. But they put out these surveys, and the JOLTS survey had a 75% response rate. That has fallen to about a 35% response rate. Now, does that mean the data is non-comparable? I think so. Does it mean it's even telling a true story if you went from 75% coverage to 35% response coverage? Well, the conspiracy theorist, which they're getting a lot more credibility as the years wear on, might say maybe they're just leaving some of the data out. Maybe they're leaving out the bad numbers. Maybe you are getting 75% of respondents, although I do believe it's probably down because people have different attitudes now than they did pre-COVID. But maybe they're leaving it out. You know, there's the payroll number that comes out every Friday. It's the establishment survey that gets all the media attention. And it's been pretty constant. You mentioned 216,000. Well, that 216,000 that came out was accompanied with revisions of about 450,000 down on past months. For the past year, I think it was. Well, maybe they just report 216,000 so they can tout how great everything is, and it ends up being revised down to, I don't know, 120. But that doesn't get any attention because that's swept under the carpet. So you put out an initial number, and there seems to be this weird propensity for them to be reduced in the revisions. And I just start to wonder why this pattern has started to develop. You know, there's a state level data as well on unemployment. The states report it. And something like 88%, they use, I think, DC, so it's 51 states, but I think 88% of them report rising unemployment. Rising unemployment, 88%. And the ones that don't have rising unemployment are Texas, I believe Pennsylvania, and those are reasonably sized states, but it's also North Dakota and Wyoming. So those are not big states. So I know North Dakota has a lot of job inflow, but it's on a low base. So I ask an interesting question. How can unemployment not be rising if it's rising in 88% of the states? I guess in the other 12% of the states, it's got to be absolutely booming. But what if we get to a point, because this percentage keeps going up, it's gone up a lot in the last 6 months. What if we have 100% of the states reporting unemployment? I think that means unemployment's going up. If 100% of the states are reporting it, it's not mathematically possible to have stable unemployment or falling unemployment. But we're starting to get into a land where it's getting a little bit hard to accept the fact that 12% of the states are replacing the rising unemployment with new employment at the other 88% of the states. So I'm wondering about the data. And we're living in a world where a lot of funny things are happening that you experience, and yet you're being told that it's not happening. Like the border is secure, the border is closed, and yet there's hundreds of thousands, millions that are being aided and abetted coming across the border. So if they're willing to tell you that the border is secure when there's over 8 million people have come in 3 years, it seems like a smaller distortion of the truth to report the true unemployment number a couple months late. So you can get the headline of it's good versus the truth that ends up coming out later. So I don't think that the inverted yield curve is meaningless. I don't think that leading economic indicators that have been falling for 21 months in a row are meaningless. And so I think investors are into this zone where it's sentiment driven rather than fundamentally driven. And that's because, and I think here's the proof statement of it, and then you can follow up. But last year the stock market went up a lot, but earnings didn't go up hardly at all. They went up 1%. So the entire move, forget about the economy, forget about the landing or not, earnings went up 1%. So the entire move is based upon momentum and on rising valuations relative to present earnings. Now, we can always dream like that we're going to have 11% earnings growth this year and 12% earnings growth next year, but it's always that way. It always starts out that's going to be 10 or 11 or 12% when they start doing the guesses about a year and a half or 2 years earlier, and then it usually goes down, and that's what happened last year. So there's a lot of money sloshing around still, and I think that's responsible for some of this market valuation.
The Grabby market.
Yeah, I think so, because the money that went out there, before the lockdowns and all of the free money, M2 was growing at a very consistent trend, the money supply. It was growing very consistently up. And then all the money comes, and so hockey sticks way up there. And of course, that's starting M2's been negative now for a while. It was negative for last year, I think, pretty much every month. But what people don't understand, and the economists that were early to predict recession tended to be more monetary economists because they have long careers and they say, hey, when M2 goes negative year over year, that's a huge warning flag for a recession. But what that sort of misses is the money's still there. It might be a little bit less. But if the trend is here and then you're up here, okay, in money supply, the trend, what's going on is M2's coming down, but we're still above trend. We're still above the trend on absolute M2 basis than where we would have been if none of this money printing would have happened and we had that same steady growth of M2. And in fact, if the money supply keeps falling at roughly the pace it's been falling for more than the past year, we won't get back to that trend of M2 for at least 18 months. So the money's still sort of hanging around. And I think that has a lot to do with why the market's so overvalued. But it's going to be hard to push it higher from these types of valuations as unemployment, the breadth of unemployment is clearly building because of the state thing that I mentioned. And also I mentioned there's an establishment survey and a household survey. The household survey is very different right now than the establishment survey. It's way weaker. So it's really a question of which one is telling the truth. And that's the problem with economic analysis is there's a million ways to spin things. Just think about how the machinations that economists and the Fed have gone to create new ways of looking at the inflation data. There's super core, there's 3 month annualized, there's 6 months annualized, there's if we put in a different shelter number and all this other stuff, and those are all valid exercises, but it's really more of a mosaic than any one data point. And so that's sort of the art of all this stuff is to put all that together.
So given the backdrop that you've laid out, what do you think the Fed will do and say next week? And what do you think they should do and say?
I think the Fed, next week, I'm pretty sure they're not going to change rates. I mean, I would say the chance of them changing rates is below 5%. And of course, if they change them, it looks like it would be to the downside. They would lower them, but I don't think that's going to happen. I think it's just a little too early for that. But the Fed has been very active in the past 2 years. They started raising rates almost exactly 2 years ago, and they started with the 25. And they were so far behind the curve. It was so easy to see that inflation was going to go way above 2% and even way above 4%. And they should have raised rates. I even said so on that day before they raised the 25. I said they should raise them 200 right now.
Right.
They're that far behind the curve. So now they've raised rates fairly aggressively, and they've risen them up about 525 basis points. And inflation has been coming down. So how do I glue these ideas together? That the Fed has raised rates 5 basis points. Inflation is coming down. Is it because of the Fed? Because how does raising rates 525 basis points in and of itself lower inflation? Don't you need slack in the economy? Don't you need unemployment? Don't you need businesses failing and stuff like this to get inflation to come down? Why? All these things don't seem to tie together to me. So the Fed wants to cut interest rates, not because they want to talk about a recession, but because real interest rates are now pretty high. The inflation rate is quite likely to go down with oil where it is today. An oil spike might change this, but if a Mideast war can't spike oil, I don't know what can. So if it stays where it is, the CPI is going to be in the low 2s by the end of this year on the headline. And so the Fed feels like, well, why not cut rates? Because we don't want this real interest rate to be so high. But I think there's another reason the Fed wants to cut rates. I do think that they realize inflation is coming down, so they don't need a recessionary reason to cut rates. They can do it because the real rate is kind of high by historical standards if the CPI is going 2.1. But one thing happened, and it happens gradually, and it always takes longer. Everything in finance, investments, and the economy takes longer than everybody thinks. Certainly this recession is taking longer than everybody thinks. But
That's what I wanted to ask you, because the last time we did Spaces, you had predicted recession is coming.
Oh, I think it is. I think we'll be in a recession by the middle of this year.
By the middle of this year?
Yeah.
Okay.
I think so. I mean, there's a confluence of indicators that have been, everything's less reliable this time because of the tremendous volatility of the money supply and all that stuff. But one thing we did do is we've taken the national debt to $34 trillion. And every time I look at it, it's crossing another trillion. And the Debt Clock website does this interesting calculation on assets and liabilities in the United States. So value of all assets and value of all liabilities. The liabilities are bigger than the assets. So we're a hedge fund that's dreading a margin call because we can't meet the margin call. Our liabilities are bigger than our assets. Now, we can always restructure our liabilities, but that's a difficult conversation for people to have. We're going to have it, but it's difficult. It has to get even worse than it is now. But with the 34 trillion, we also have rising interest rates. The Fed, by raising rates 525 basis points, has increased the interest expense on the national debt by hundreds of billions of dollars per year. And that interest rate is going vertical. If they leave Fed funds rate where it is right now, you are going to have the cost of servicing the Treasury debt go up to a huge percentage of tax receipts. Now, there's a lot of assumptions involved. Assumptions are, what's the annual deficit as a percentage of GDP? Where are interest rates going to go? What are outlays going to be, and all this stuff. But the CBO tries to do this, and the CBO does this thing. But they assume there'll never be a recession. They assume basically sort of a 2% real GDP. Their analysis today assumes interest rates that are lower than today's interest rates. They use about a 3%, and they assume that the budget deficit is going to be about 3 or 4% of GDP, even though it's already over 6% of GDP, and apparently we're not in a recession. So the deficit is, all the CBO's numbers are very, very optimistic. Furthermore, they assume that there will never be a recession ever. Because and I don't blame them for that, because how can you plan in the numbers? So whenever you see the numbers produced by the CBO, you know they're optimistic. And I think it was Druckenmiller, that did an interview that got a lot of play on a Monday a few weeks ago, where he was saying that we got a real problem here because the interest expense is going to go to like 20% of tax receipts. That's the CBO's number. If you actually use more realistic numbers, let's say that the deficit goes up because the economy is weakening and it goes to 8% of GDP. What if interest rates stay where they are? And this is where the Fed comes into play. But if all that happened, we would have, within 5 years, we would have, depending upon what interest rate you assume, we could have 30, 40, 50, 60% of all tax receipts go to interest expense, which of course is not possible. And if you really want to get draconian about it, if you assume a 12% deficit as a percent of GDP, which is possible the way we've been acting, and you assume like a 9% interest rate, which I know is kind of high, these are high numbers, then within 5 years, the interest expense on the national debt would be greater than the tax receipts under the current tax system. Think about that. So what happened is we borrowed ridiculous amounts of money because interest rates are at zero. You know, it's like giving a kid, too much candy. They can't stop. They don't worry about how they're going to feel terrible in 3 hours. They just can't stop. So at zero interest rates, you've got carte blanche for policymakers at Treasury and so forth to borrow infinite amounts of money, which we did a lot of because interest rates were at zero for so long.
Right.
The 10-year Treasury was at 1.5 for so long.
It's like free money.
Yes, the 2-year, the 3-year, the 5-year, 50 basis points lower, 25 basis points. All those are rolling over now because interest rates have been rising now for a couple of years. So all the 2 years that were issued in 2022 are coming due in 2024. All of the 5 years that were issued in 2000 are coming due next year. All the 5 years issued in 2019 are coming due this year. And the interest rate is 400 basis points higher, 500 basis points higher it was. Now it's only 400 basis points higher. That's huge because we have $17 trillion of bonds maturing in the next 36 months. 17 trillion. So think about this interest expense is going over $1 trillion in a hurry. And so I think the Fed says, let's not induce financial economic pain, interest expense pain, more than we have to anyway. So let's find a reason to think about we don't need real interest rates this high. So if inflation's coming down, and I don't think, I have a hard time understanding why inflation's coming down if you accept the narrative that this is such a great economy and there's no landing and everything's totally fine. Why is inflation coming down then? I don't know. I mean, there must be economic weakness, at least globally. One of the ways that I explain...
Well, there is in China.
China's a disaster. Mm-hmm. Yeah. China is very negative, and that's bleeding over into emerging markets broadly. Oil prices can't go up even though the petroleum reserve isn't being drained anymore. At least I hope not. It's already pretty low. We have hot wars, right? We've got Red Sea problems. We've got all this going on, and oil doesn't go up. Why? Demand must be low. Why is demand low? Well, the global economy can't be all that great. And so there's all kinds of contradictions in the data. And but the Fed relenting on what seemed like autopilot, they didn't use those words this time, but it felt like they were sort of autopiloting there for 18 months at least. They pivoted, I think, because they realize that inflation's coming down. We don't want to exacerbate the interest expense, and the economy really isn't that strong globally.
So what do you buy in this environment?
That's
what do
very
interesting
interesting question.
What do you avoid?
Parts of the credit market, most parts of the credit market, even down the capital structure, if you look at the CLO market, the bank loan market, one thing we look at, people talk about yields, they talk about spreads. On some of these products, one of the most helpful metrics is to look at the prices. So we saw a certain buoyant price level in the first part of 2020 on all of these asset classes. Stocks were high too. And then we had the economic lockdown. And the Fed came in and rescued the corporate bond market, which is against the laws of their charter, but they did it anyway. So the things that the Fed didn't support had very poor liquidity and were incredibly low. So bonds that were at, say, 94, so now we're talking bottom part of the capital structure, went down to like 40. And they were very slow to recover. They came halfway back within several months, but then languished again. Well, they're all the way back. The prices are all the way back to where they were in the first part of 2020. So all of that distress is gone. So what I would say is for all of these things that have recovered and gone all the way up, there's really a very poor risk-reward profile. So you don't want to own them. So we owned, a few months ago, AAA rated CLOs were at not huge discounts, but discounts. And there were other parts that you had a reasonable chance that they were going to get called away from you, which is now happening. So if you could buy them at 96 cents on the dollar and they're going to be called in 6 months, it's like this really great risk reward. Those are all above 100 now.
Didn't you also have a saying at DoubleLine, T-bill and chill, or what? Were
No,
you misquoted, or
yeah, I was misquoted. I mean, we did say that investors are opting for T-bills.
Okay.
And it's like 6-month bill and chill, T-bill and chill.
Okay.
Okay? But I never recommended that because you don't have it for long enough. 5.5 on the 6-month bill is great for 6 months, but what happens if you have to reinvest it at 3? I said 5.5 T-bill, there's nothing wrong with it, but you're way better off in the middle part of the capital structure, say single A, triple B, some double A, on these things that yielded, at that time, we're talking about October, at that time spreads were still wide on these parts of the capital structure. And you were looking at a 2-year Treasury, a 3-year Treasury base rate that was about 5.25. And you were throwing spreads of like 450 basis points on top of that. So that's what I was recommending.
Okay.
So that you were able to get 9 without even trying and with almost no risk. And you want that for more than 6 months. If I can get a 9 in a 2% inflation world or a 3% inflation world, I want that. I don't want it for necessarily for 30 years, although I'd probably take that too. But that yield wasn't available on the long end because the curve was inverted by 108 basis points, 2s, 10s. But a 3-year, a 4-year portfolio, something like that. That's what I recommended. Now, that's done incredibly well because the spreads have tightened in, rates are down broadly. I mean, we have not esoteric strategies, fairly center of the fairway strategies, middle of the fairway strategies that were up like 8% in the last 2 months of last year. And since November 1st pivot by the Fed are up like 12%. It's just incredible. Well, that's great for for that 3-month holding period. But what about the future? Because now the base rate's down at 4 and the spread is not taking it to 9. So now you're at like 6.25. You've had this massive repricing and the fundamentals aren't any better. So I'm talking about CMBS, asset-backed securities. So I think, we owned a lot of this stuff. We thought there would be a year-end effect. Mm-hmm. Everything's always more extreme than everybody thinks. It takes longer. The move is faster. These things have repriced very substantially this year. And so you sort of have to start thinking about cash because I think there's going to be a lot of opportunities. I'm not saying 100% cash, but I'm saying I think 20% at least, 25% cash, because I think this stuff's going to get cheaper.
What about gold and Bitcoin?
I like gold. I have no interest in Bitcoin. I think the worst idea I can think of, it has one substantial benefit. These ETFs, that are regulated. Uh-huh. At least you can't lose all your money if you lose your password. At least it's in a fund. But one of the appeals of Bitcoin is supposed to be that it's like the Wild West and you're free of the government and it's not regulated. So you're going to go to a regulated vehicle to buy the thing that you are attracted to because it's unregulated? There's some really bad contradiction there. And also, I think Bitcoin, I think that I think the reason that people have convinced themselves to like it is because the blockchain record stays around immutable forever. That means that it's extremely non-confidential. It's extremely non-secretive because the record's there forever. So it's the opposite of secretive. Any regulator, any government entity can figure out that they convict felons on their Bitcoin uses, right? Bitcoin gets stolen and they find it, at least in part. So these things all contradict each other. I like gold simply because the economic system is in a bad shape. And the response to problems as they develop in the economic system, and I mean this globally, but obviously also in the United States, the response in the developed world is to take rates to zero and give people money. And you know, Jennifer, I've been talking about this for a long time.
I think over
that this is coming.
Over a decade.
And I would say they're going to give money away. And it's not going to be the $300 like George W. Bush did in the aftermath of the global financial crisis. They gave people like $300.
Mm-hmm.
It's going to be way more than that. Well, I think I've been proven right. Now, sure, very extreme economic circumstance in 2020, 2021, but they gave many, many, many people tens of thousands, hundreds of thousands of dollars, and that's their trick. So what are you going to do when the next recession comes and you have a true problem with the deficit? You're going to do quantitative easing. You're going to give people money because that's been the game plan for the past 16 years. And every time it happens, two things happen that are really the same thing in different manifestations. First thing is they give people more money than they did the last time. And the other thing that goes along with that is the deficit expands more than ever before. So it used to expand at about 4% during recessions. I'm talking say 2005 or something like this, or 1999 anyway. And then it went to 6% in the recession of 2000, and then it went to 9% expansion of deficit GDP in the global financial crisis, and then in the COVID situation, it went to something like I don't remember exactly, but it was something like 12% GDP. So if it's going to be, the trend is pretty clear. Now, trends can reverse, but I think when the deficit comes, when the recession comes, you're going to be looking at least a 9% of GDP budget deficit, and temporarily it'll be double digit.
So what's your best course of action to fix the deficit?
We've got to restructure. Well, the deficit is bad enough. It's the unfunded liabilities that are the big problem. We have $210 trillion of unfunded liabilities. $210 trillion. How are we going to pay that back in today's money? How are we going to fund those in today's money? We would have to take 10% of GDP and set it aside to fund these for 70 years to pay that. That would be a depression for 3 generations. Mm-hmm. That's not going to happen. So what are we going to do? We're going to restructure them, which means the conversation that nobody wants to have, and they won't have it until it's really frightening, and it's getting there. We're getting closer for sure. You have to means test. You have to raise the eligibility ages on these programs, and in some, you have to tax other places. You have to tax college endowments. That you have to get money where you can get it, but you also have to reduce the absolute nominal dollars that are unfunded by canceling some of the liabilities, reneging on them, mm-hmm. defaulting on them. Another thing you could do is you could restructure the Treasury debt. You could announce by fiat that all the existing stock of Treasury debt is being refinanced into 50 basis point or 0 coupon. Then you don't have any interest expense. Now, people think that's a radical idea, but I've got news for you. We've already opened the door to that. We've already opened the door because in 2007-8, there were prospectuses that said it in no uncertain terms that the mortgages that were the collateral for this bond issuance cannot be modified. They cannot be modified by terms of the law, the prospectus, but they did it anyway. So there it is. The door's been open. They've taken things and restructured them. How about student loan debt that's been canceled against the laws of the United States per the Supreme Court? No, you can't do this, but they're doing it anyway. So it'll be some combination of these radical methods.
So we're going to take audience questions. I have one last question. Who's going to win the presidential election?
It's really hard to say because it's hard to say who's going to be running. Clearly, Trump, if left alone, would win the nomination at this point. I think that's pretty clear. He's got one person running against him, and he just won 55% of the vote in a not terribly, red state in New Hampshire, and and he's polling in the upcoming states. He's polling ahead by 30 points. Mm-hmm. Now that seems like a pretty big gap. I suppose things can change, but he would win outright. The question is, to what extent will states be allowed to interfere in the election by banning people from ballots? I mean, I think that's a low probability, but I wouldn't write anything off. So the base case, I think Trump has a better chance than Biden. Predict it has been going back and forth. That's the betting market. They're both been about the same number. I think Biden is a little bit ahead as of today by a couple of cents. But it tells you that there is no clear consensus about what's going to happen there. I find it very hard to believe that Biden will actually run for re-election.
Really?
Yeah, I think everybody knows that he can't debate. He can't. I don't see how he could possibly do an hour and a half debate. His stamina, his seemingly his physical condition, certainly the slurring of the words, the strange things about talking about people that are dead, being in the audience and stuff like this. I mean, Trump does some of this stuff too, but the regularity with which Biden does it is concerning. And so I just can't imagine him thinking, or his people thinking, it's a good idea to have him in office for another 4 years, another 5 years from today. It's just unthinkable to me. So I think Trump would win, but the question is, what will they do to stop him? Because what they've done so far is pretty telling. I mean, this ridiculous thing with Fani Willis. I mean, you know how that fell apart. This ballot, this states, just unelected officials at states saying you're not allowed to run on our ballot. Mm-hmm. I mean, this is pretty strange stuff. We see it on a day-to-day basis, and so we don't understand how big the delta is. One thing I like about talking to foreign clients, I have a good friend of mine, been a client of mine for years in the Middle East, and we talked to him, and I said, what do you think about trend of the U.S. and what's going on? He says, Jeffrey, what's going on in your country is just surreal, And so we're going to have to reset. I've been talking about this for years, but it gets closer and closer. When I started in this business, people said, wow, we got a big problem with the demographics of the Social Security. Here it is, let's say it was 1985 or something, and people say, hey, it's going to go bankrupt by 2050. We got to really start worrying about this. And nothing happens. Then 10 years pass, you're at 1995, it's well, actually it's 2040, we're going to have a problem. So you're getting squeezed. The walls are coming in on both sides. Time is passing, and the reckoning day is being brought forward. Well, now, here we are in 2024, and the trustees of Medicaid or Medicare say they're done in 2030. They're broke. That's in 6 short years. Mm-hmm. Social Security trustees say 2032. But I got news for you. Those projections assume no recession all that time. So since it keeps being brought forward, and the chance of recession is clearly non-zero, I will agree that it seems to be a little bit lower than it was, say, last March. We had SVB and all that stuff. But I still think it's definitely non-zero. I mean, we're talking about those programs running out of money. I say 2026 and 2028. So this is something that we have to deal with real soon. And we're going to have to do it. And when you start moving the pieces around on the game board, it kind of offers a freedom to change other things too, because change is in the air. It's kind of like when you hear that everybody's at full employment and nobody wants to lay people off. I mean, one of the economic aftermaths of the lockdowns and the whole COVID thing is there was this wave of humanitarianism that took over. You don't have to pay your student loan, you don't have to pay your rent, we're going to give you some money, we're going to take care, no one's going to lose their job, we're going to get paycheck loans and all this stuff. What went along with that was nobody's going to lay anybody off. And that's wearing off. You see layoffs a lot in the news. I already referenced that 88% of the states, unemployment's going up. You see company A laying off 5%, company B laying off 8%. How many thousands of jobs here? How many tens of thousands of jobs here? And once that starts happening, it's kind of like when the supply chain thing hit really hard. And you had earnings calls and the CFOs all said the same thing. Well, it's the supply chain. Our earnings are hurt because of the supply chain. And you say it because I say it. And I say it because he says it. And he says it because she says it. And so suddenly everyone's like nods their head. Yeah, it's that supply chain thing. Well, once everyone's laying people off, you say, this is an industry trend. Just look around. I mean, these big firms, I'm not going to name names, but there's some significant layoffs that are happening. And that changes. We're no longer in the humanitarian, thing. We're now in it's, what? We have to shore things up here. And that means a weaker economy.